What if the difference between winning and losing in the stock market could be narrowed down to just 5 rules? What if, by mastering these 5 principles, you could confidently navigate the world of stocks, avoiding the noise, ignoring the hype, and building real, lasting wealth? In a world overflowing with investing advice, financial news, and flashy stock tips, most investors feel overwhelmed. They jump from strategy to strategy, chasing trends, reacting to market swings, and often losing money, not because they lack intelligence, but because they lack a reliable framework. Pat Dorsey, the author of the 5 Rules for Successful Stock Investing, provides that framework. And this is not just another investment writer. Pat Dorsey is a man whose words carry weight. He is the former director of equity research at Morningstar, one of the most respected independent investment research firms in the world. Morningstar's influence is global. It provides unbiased, data-driven analysis that professional investors and institutions trust to make billion-dollar decisions. During his tenure, Dorsey was instrumental in creating Morningstar's economic moat rating system, a groundbreaking method for identifying companies with sustainable competitive advantages. This concept of economic moats is now one of the most essential tools in modern stock analysis, used by both individual investors and top-tier fund managers to separate lasting businesses from temporary success stories. In short, Dorsey's work reshaped how the investment world thinks about long-term value. But why should you, the listener, trust his insights? Because Dorsey didn't build his reputation by offering get-rich-quick schemes or chasing market fads. His entire career has been focused on helping investors cut through the noise, think critically, and invest with confidence, not through speculation, but through understanding. In this book, Dorsey distills decades of investment wisdom into 5 clear, actionable rules. He teaches you how to think like a true investor, not a gambler. He shows you what to focus on, what to ignore, and how to avoid the most dangerous traps that destroy wealth. What makes the 5 rules for successful stock investing stand out is not just its simplicity, it's its depth. These are not shallow tips. They are time-tested, data-supported strategies that align with how professional investors approach the stock market. But here's the best part. You don't need a finance degree to understand them. Dorsey breaks down complex ideas into clear, digestible lessons. He explains what really matters when analyzing a company, beyond the glossy reports and the flashy headlines. He teaches you how to read financial statements without fear. He shows you how to spot companies that are built to last and how to price them wisely. If you stick with this audiobook, here's what you will gain: a deep understanding of the 5 essential rules that can guide your stock investment decisions for life, the ability to spot dangerous investment mistakes before they cost you money, clarity on what makes some companies worth holding for years, while others should be avoided entirely, practical skills to analyze financial statements and see beyond the surface, insight into how to approach different sectors, from technology to healthcare, with precision and confidence. You will also discover why most people fail in the stock market. Not because they lack information, but because they chase short-term success, follow the crowd, and ignore the fundamentals. Dorsey will show you how to resist those traps. He will also introduce you to one of the most powerful but underused ideas in stock investing: economic moats. These moats, like a company's pricing power, brand loyalty, or cost advantages, are the real secret behind long-term success in business. Understanding this concept alone could transform the way you choose stocks forever. But before we begin, here's something you must remember. This is not a list of quick fixes. These are not promises of overnight riches. This book is about building wealth the right way, with discipline, patience, and a focus on what truly matters. The principles you're about to learn will help you invest with confidence, avoid common mistakes, and build a portfolio that can stand the test of time. So why does this matter to you? Because the stock market can be intimidating. It's easy to feel lost, confused, and tempted by the next hot tip. But when you have a proven roadmap, like the one Dorsey provides, you can invest with clarity and peace of mind. You can stop guessing. You can stop reacting to every market dip. You can start building a strategy that grows with you. By listening to this audiobook summary, you're not just saving time, You're positioning yourself to make smarter decisions for your financial future. Pat Dorsey has spent years helping investors see the truth behind the numbers. He has built systems that help filter out bad investments. He has trained thousands of professionals on how to think with discipline and how to separate hype from value. Now, through this audiobook summary, you can benefit from that same wisdom, simplified, focused, and ready for you to apply. As we move forward, we will break this book down chapter by chapter. Each chapter offers essential lessons that build on one another. We will not just mention the rules. We will explore them, illustrate them with examples, and connect them to real-world investing situations. By the end, you'll have not just heard the 5 rules. You will understand them. You will know how to use them, and you will be better prepared to win, like the smartest investors do. Let's begin. Chapters 1, 2, and 3. Building the foundation of smart investing. To succeed in the stock market, you cannot afford to be passive. You must actively equip yourself with the right knowledge. This is the foundation of Pat Dorsey's first rule. Do your homework. Many investors make the mistake of diving into stocks based on a friend's recommendation, a news headline, or a sudden market surge. They buy shares without understanding the company's business model, financial health, or long-term prospects. This is like boarding a ship without checking whether it's seaworthy. It's not investing, it's gambling. Doing your homework means going beyond the surface. It's about learning what the company really does, how it makes money, who its competitors are, and whether its success is sustainable. It's about reading financial statements, understanding the risks, and asking critical questions before you commit your hard-earned money. But Pat Dorsey doesn't just tell you to do your homework. He shows you what that homework looks like. He emphasizes that you don't need to be a financial wizard to analyze a company. What you need is curiosity, discipline, and a willingness to dig a little deeper. He explains that companies exist in different industries, and each industry has unique dynamics. Your job is to understand those dynamics and determine whether a company has what it takes to thrive over time. And that brings us to the second rule: find economic moats. An economic moat is a company's ability to protect its profits from the relentless forces of competition. It's what keeps rivals at bay. Imagine a medieval castle with a wide, deep moat filled with water and crocodiles. The stronger the moat, the harder it is for enemies to breach the walls. In the business world, companies with strong economic moats can maintain high profit margins and defend their market share, even when competitors try to attack. But not all companies have moats. Many businesses experience temporary success because of a hot product, a short-term market trend, or a burst of investor excitement. Without a moat, that success fades as soon as competitors catch up. The key is to find companies that have durable advantages that can withstand the test of time. Dorsey identifies several types of moats that investors should look for. For example, a strong brand can create customer loyalty that competitors can't easily break. Think of companies like Coca-Cola. Cost advantages can allow a company to produce goods more cheaply than anyone else, making it hard for rivals to compete on price. Network effects occur when the value of a service increases as more people use it, like social media platforms or payment networks. And switching costs can lock customers in, making it expensive or inconvenient to leave, which strengthens the company's hold on its customer base. When you find companies with moats, you're finding businesses that can sustain profits, outlast competitors, and reward shareholders over the long term. But even when you do your homework and find a company with a solid moat, you still face the risk of overpaying. This leads us to the third rule: always have a margin of safety. A margin of safety is a buffer. It's the gap between what you pay for a stock and its true value. Why is this important? Because no matter how careful you are, the future is uncertain. Your analysis might be wrong. The company might face challenges you didn't foresee. The economy could take unexpected turns. If you pay too much for a stock, even a great stock, you leave yourself vulnerable to these risks. Dorsey stresses that successful investors don't just look for great companies. They look for great companies at the right price. Even the best businesses can be terrible investments if you overpay. Having a margin of safety protects you when things don't go exactly as planned. It's like building a bridge that can support more weight than you expect to carry. You design the bridge with extra strength, just in case. In investing, you want to buy stocks at prices that assume a little bit of uncertainty and a little bit of human error. This gives you room to absorb unexpected setbacks without losing your entire investment. Dorsey explains that the stock market often offers opportunities where fear or impatience drives prices lower than they should be. When the market overreacts to short-term news or earnings misses, you can find valuable stocks trading at discounted prices. These moments provide the margin of safety that smart investors seek. But to recognize those opportunities, you must first do your homework. You must understand the company and its moat so you can tell when a stock is truly undervalued, not just cheap-looking. These first 3 rules are not isolated ideas. They build upon each other. When you do your homework, you develop the knowledge to spot quality companies. When you look for moats, you find businesses with lasting power. When you demand a margin of safety, you protect yourself from the unpredictability of markets. Together, these rules form the backbone of intelligent investing. They help you step away from speculation and emotional decisions. They guide you toward thoughtful, disciplined strategies that can grow wealth over time. And here's something else to remember. These rules are not hard to understand, but they are hard to follow consistently. It's easy to skip your homework when a market feels exciting. It's tempting to chase popular stocks without checking if they have moats. It's dangerous to overpay when fear of missing out takes over. But Pat Dorsey's message is clear. The smartest investors win because they stick to these rules, even when others don't. As we continue this audiobook, you'll learn not only the remaining rules, but also the common traps that trip up even experienced investors. Let's move forward. Chapters 4 and 5. The long game and knowing when to let go. Investing is not about making a quick profit. It's about building wealth patiently. Pat Dorsey's 4th rule, hold for the long haul, is a simple idea, but it's one that most investors struggle to follow. The stock market rewards those who think in decades, not in days. Unfortunately, many people panic at the first sign of trouble or become impatient when a stock doesn't deliver instant results. They jump in and out of investments, chasing the next big thing, often buying high and selling low. But Dorsey makes it clear, long-term ownership is where real wealth is built. When you find a company with a durable moat, a strong financial position, and competent management, the best move is often to buy and hold. Not for weeks or months, but for years, even decades. Compounding is a powerful force, but it needs time to work. The longer you stay invested in a good company, the more those small gains accumulate and multiply. Dorsey emphasizes that most great businesses don't deliver spectacular growth in short bursts. They grow steadily, sometimes slowly, but their value increases consistently over time. The stock price may fluctuate, but the underlying business continues to strengthen. Investors who can sit through the inevitable ups and downs are often the ones who achieve the most impressive results. But holding long-term is not about ignoring reality. There are situations when selling is the smart decision. That brings us to Dorsey's 5th rule, know when to sell. Selling is one of the hardest parts of investing. Some people sell too soon, cashing in small gains and missing out on the real long-term rewards. Others hold on too long, refusing to let go of a company that has fundamentally changed for the worse. Dorsey offers clear guidelines for knowing when it's time to sell. First, if the company's moat is eroding, it's a signal to reevaluate. Maybe a new competitor has emerged, or the company's cost advantage has disappeared, or customer loyalty has weakened. When the company's durable advantage starts to vanish, the long-term thesis that justified your investment no longer holds. Second, sell when management's behavior changes. If leadership starts making reckless decisions, if financial discipline erodes, or if honesty becomes questionable, it's time to reassess. A company's management team is crucial to its success. When their priorities shift away from building long-term value, your investment is at risk. Third, sell when the stock becomes significantly overvalued. Even a great company can become a poor investment if its stock price has climbed far beyond what the business is realistically worth. Sometimes the market's excitement drives prices to unsustainable levels. In such cases, locking in profits and moving on can be wise, especially if you have better opportunities elsewhere. But Dorsey also warns investors not to sell based on short-term news, market panic, or temporary setbacks. Even the strongest companies experience bumps in the road. Missed earnings, market corrections, negative headlines. These moments test your patience, but they don't always mean the company's long-term potential has changed. Successful investors develop the discipline to distinguish between temporary noise and genuine warning signs. In both buying and selling, the key is rational analysis, not emotion. Dorsey stresses that you should always return to your original investment thesis. Ask yourself, has the core reason I bought this stock changed? Is the moat still strong? Is management still focused? Is the stock still fairly valued? If the answer is yes, the best move is usually to hold, even when the market gets volatile. If the answer is no, it may be time to sell and protect your capital. These final two rules, holding for the long haul and knowing when to sell, are really about mastering your own behavior. The market will test your patience, challenge your confidence, and tempt you to react emotionally. But following these rules helps you stay grounded. Think of it this way. Doing your homework helps you find great companies. Looking for economic moats helps you pick the right businesses. Having a margin of safety helps you buy at the right price. Holding for the long term allows compounding to work in your favor. And knowing when to sell protects you from sticking with a stock that no longer deserves your investment. When these 5 rules come together, they form a complete system for smart investing. Pat Dorsey's advice is powerful because it's not complicated. It's focused on timeless principles that anyone can understand, but few consistently apply. His message is that success in stock investing isn't about predicting the next market move. It's about discipline. It's about patience. And it's about focusing on the fundamentals. When you follow these 5 rules, you remove much of the guesswork from investing. You begin to see the market not as a casino, but as a place where thoughtful research and long-term thinking are rewarded. But there are still dangers that can derail even the most disciplined investors. In the next section, Dorsey will guide us through the common mistakes investors make. Mistakes that can quickly undo years of smart decisions. Let's continue. Chapters 6 and 7. Avoiding the pitfalls that destroy wealth. Even when you know the rules of smart investing, there are powerful forces that can pull you off course. In chapters 6 and 7, Pat Dorsey focuses on the most common mistakes investors make. Mistakes that can quickly erode your wealth, no matter how well you've chosen your stocks. The first danger is one of the most persistent, following the herd. Human beings are naturally wired to look to others for guidance, especially when they feel uncertain. In the stock market, this often translates to a dangerous pattern of chasing what's popular. When a stock or sector is gaining attention, investors tend to pile in, not because they've carefully analyzed the company, but because everyone else seems to be doing it. The fear of missing out drives buying decisions. But Dorsey warns that following the crowd often means you're arriving late to the party. By the time the masses are pouring money into a stock, the price has usually been driven well beyond its fair value. What seems like a safe, popular choice can quickly become an overpriced trap. History has shown this time and again. The dot-com bubble of the late 1990s, the real estate surge before the 2008 financial crisis, and countless other market manias all followed the same pattern. Excitement builds, prices soar, people rush in without understanding, and eventually, the bubble bursts. Successful investors resist this pull. They rely on their own research, their understanding of economic moats, and their commitment to paying a fair price. They have the courage to ignore the noise, even when everyone else seems to be moving in the opposite direction. Another major pitfall is letting emotions drive your decisions. The stock market can be an emotional roller coaster. When stock prices rise, it's tempting to become overconfident, believing that you can do no wrong. When prices fall, fear takes over, and many investors panic, selling out of good companies at the worst possible time. Dorsey emphasizes that emotions are one of the biggest threats to investment success. Emotional investors often abandon their carefully planned strategies the moment the market becomes volatile. They switch from long-term thinking to short-term survival mode, making decisions based on anxiety rather than logic. The first danger is one of the most persistent: following the herd. Human beings are naturally wired to look to others for guidance, especially when they feel uncertain. In the stock market, this often translates to a dangerous pattern of chasing what's popular. When a stock or sector is gaining attention, investors tend to pile in, not because they've carefully analyzed the company, but because everyone else seems to be doing it. The fear of missing out drives buying decisions. But Dorsey warns that following the crowd often means you're arriving late to the party. By the time the masses are pouring money into a stock, the price has usually been driven well beyond its fair value. What seems like a safe, popular choice can quickly become an overpriced trap. History has shown this time and again. The dot-com bubble of the late 1990s, the real estate surge before the 2008 financial crisis, and countless other market manias all followed the same pattern. Excitement builds, prices soar, people rush in without understanding, and eventually the bubble bursts. Successful investors resist this pull. They rely on their own research, their understanding of economic moats, and their commitment to paying a fair price. They have the courage to ignore the noise, even when everyone else seems to be moving in the opposite direction. Another major pitfall is letting emotions drive your decisions. The stock market can be an emotional roller coaster. When stock prices rise, it's tempting to become overconfident, believing that you can do no wrong. When prices fall, fear takes over, and many investors panic, selling out of good companies at the worst possible time. Dorsey emphasizes that emotions are one of the biggest threats to investment success. Emotional investors often abandon their carefully planned strategies the moment the market becomes volatile. They switch from long-term thinking to short-term survival mode, making decisions based on anxiety rather than logic. To counter this, Dorsey encourages building systems that keep your emotions in check. Having a written investment plan helps. One that clearly outlines why you bought a stock, what would make you sell it, and how you intend to react to market swings. When volatility hits, you can refer back to your plan and remind yourself of the long-term view. Patience is a powerful antidote to emotional investing. When you've done your homework, when you've identified companies with durable moats, and when you've bought with a margin of safety, your best strategy is often to wait. Let time and compounding do their work. But emotional mistakes aren't just about fear. Greed plays a role, too. Investors sometimes take on excessive risk chasing higher returns. They buy speculative stocks or invest in companies they don't fully understand because they're lured by the possibility of big, fast profits. But as Dorsey points out, those profits rarely materialize in a sustainable way. Speculative investing may feel exciting in the moment, but it's not a sound path to long-term wealth. Another common mistake is failing to diversify. Some investors become overly concentrated in just a few stocks or in a single sector. They put too much trust in one idea, forgetting that even great companies can face unexpected challenges. A well-diversified portfolio spreads risk and increases the chances that strong performers will balance out weaker ones over time. Dorsey also cautions against overtrading. Many investors feel the need to constantly buy and sell, believing that frequent action equals smart investing. But often, all this activity does is generate transaction fees, taxes, and emotional exhaustion. In most cases, simply holding well-chosen stocks is far more profitable than constantly jumping in and out of the market. Underlying all these mistakes is a deeper issue: a lack of discipline. It's easy to understand the 5 rules of smart investing. But often, all this activity does is generate transaction fees, taxes, and emotional exhaustion. In most cases, simply holding well-chosen stocks is far more profitable than constantly jumping in and out of the market. Underlying all these mistakes is a deeper issue: a lack of discipline. It's easy to understand the 5 rules of smart investing, but it's hard to consistently follow them, especially when emotions, peer pressure, and market noise try to pull you off course. Dorsey's message is clear: discipline is your greatest competitive advantage. Most investors won't stay the course. Most will abandon their strategy in the face of fear or greed. If you can remain disciplined, if you can stick to your process, trust your analysis, and stay focused on the long term, you will already be ahead of the majority. Avoiding these mistakes is not about perfection. It's about awareness. It's about knowing the traps and having the mental tools to sidestep them. Dorsey doesn't promise that following his advice will make you rich overnight. He promises something more valuable: the ability to build wealth methodically, patiently, and with far less stress. In the next section, Dorsey will introduce a deeper exploration of economic moats. He will show us how to identify them, measure their strength, and understand why they're the single most important factor in predicting a company's ability to sustain profits. Let's continue. Chapter 8. The Power of Economic Moats. The real secret to sustainable success. In the world of investing, many people spend their time chasing the next big thing, focusing on rapid growth, short-term stock movements, or hot sectors. But Pat Dorsey makes one thing clear. If you want to build true, long-term wealth, you must focus on companies that have what he calls economic moats. An economic moat is a company's ability to protect its profits from competition. It's the edge that keeps rivals from easily stealing market share. Without a moat, even the most successful company can be overtaken when competitors offer lower prices, better products, or more innovative services. But with a moat, a company can maintain its dominance and continue to grow steadily over time. Dorsey explains that finding economic moats is the most reliable way to identify companies that can deliver sustainable value. In fact, he argues that a company's moat is far more important than temporary advantages like recent earnings growth or short-term market trends. So, what exactly creates an economic moat? Dorsey identifies several key types. One of the most powerful moats is a strong brand. Brands like Coca-Cola, Nike, or Apple have built deep emotional connections with consumers. People don't just buy their products. They trust them, they associate them with quality, and they return to them repeatedly. A strong brand can allow a company to charge premium prices and retain loyal customers even when cheaper alternatives exist. Another type of moat comes from cost advantages. Companies that can produce goods or deliver services at a significantly lower cost than their competitors enjoy powerful protection. These cost advantages can come from economies of scale, unique manufacturing processes, or access to cheaper resources. When a company can make its products more efficiently, it can offer competitive prices while still maintaining healthy profit margins, making it hard for rivals to compete. Network effects also create strong moats. This happens when the value of a product or service increases as more people use it. Social media platforms, online marketplaces, and payment systems benefit from network effects. For example, Facebook became more valuable as more people joined because users want to be where their friends are. The same goes for platforms like eBay or Visa. New competitors struggle to gain traction because it's difficult to convince people to leave an established network. Another subtle but powerful moat comes from high switching costs. Some companies make it very difficult or expensive for customers to switch to a competitor. This is common in industries like software or business services. Once a company is deeply integrated into a particular system, like a payroll software, an operating system, or a logistics platform, moving to a new provider can be time-consuming, risky, and costly. This creates customer stickiness that protects the company's profits. Finally, regulatory advantages can sometimes act as moats. Certain industries have high legal or government-imposed barriers that limit competition. Utilities, for example, often face limited competition because governments control who can operate in a given region. While not always the strongest moat, regulatory protection can provide long-term stability for some companies. But Dorsey warns that not all competitive advantages qualify as true moats. Some are temporary. A popular new product, for example, might give a company a surge in profits, but without other defenses, competitors will quickly copy it. Fast growth is not a moat. Large size is not necessarily a moat. Even leading market share can disappear if competitors offer something better. The key to finding real moats is understanding why a company's advantage will last. Dorsey encourages investors to study a company's history, its pricing power, its customer loyalty, and its ability to defend profits even during tough economic times. Does the company consistently earn high returns on capital? Has it demonstrated resilience in the face of competition? Does it have something that others can't easily replicate? When you find companies with strong, sustainable moats, you're not just buying stocks, you're buying businesses that can win over decades. But Dorsey emphasizes that simply finding a moat isn't enough. You must still pay a reasonable price. A great company can be a terrible investment if you overpay. That's why he continually reminds us of the importance of the margin of safety. Throughout this section, Dorsey's core message is clear. Economic moats are the ultimate shield against competition. They give companies pricing power, customer loyalty, and long-term staying power. And for investors, they offer a level of protection against the unpredictable forces of the market. When you combine your research, your patience, your attention to valuations, and your ability to spot moats, you dramatically increase your chances of success. But Dorsey also understands that different industries offer different types of moats. What works in one sector may not work in another. In the next part of the book, he guides us through how to analyze companies by industry, showing how moats appear and operate in sectors like consumer goods, healthcare, financial services, and technology. As we move forward, we will explore these industry-specific lessons, helping you become a sharper, more focused investor across a variety of sectors. Let's continue. Chapters 9 to 13, How to Analyze a Company, Unlocking the Story Behind the Numbers. When it comes to investing, numbers tell stories. But many investors either misunderstand these stories or fail to read them altogether. In this section of the book, Pat Dorsey takes us behind the curtain of a company's financial statements and shows us how to read them, not as a technical exercise, but as a way to truly understand a business. Dorsey begins by explaining that financial statements are not just collections of figures. They're windows into a company's health, strategy, and performance. Learning to read them is not optional. It's essential. The first key document is the income statement. This is where you find a company's revenues, costs, and profits. It shows whether the company is making money and how efficiently it's doing so. But Dorsey warns that you shouldn't just look at whether revenues are growing. Revenue growth is meaningless if profits aren't following. Some companies can grow sales rapidly but lose money in the process, either because their costs are too high or because they're chasing growth at the expense of profitability. Instead, Dorsey advises us to track profit margins. The profit margin tells you how much money a company keeps after covering its expenses. Strong, consistent profit margins usually signal that a company has pricing power, meaning it can charge prices that reflect the value it provides. Weak margins, or declining margins, may indicate that competition is eroding the company's position. But numbers alone are not enough. You must also understand revenue patterns. Is the revenue coming from a single product, a handful of big customers, or is it spread across multiple sources? Companies that rely too heavily on one customer or one product are often vulnerable to sudden shocks. Diversified revenue streams are usually safer and more sustainable. Next, Dorsey emphasizes the importance of studying the balance sheet. The balance sheet is where you see what the company owns and what it owes, assets and liabilities. It gives you clues about the company's financial strength. One critical area to examine is debt management. A company with too much debt is living dangerously. If interest rates rise, or if earnings temporarily fall, excessive debt can quickly become a noose around the company's neck. Dorsey advises looking at the company's debt-to-equity ratio and interest coverage ratio. These help you gauge whether the company can comfortably handle its debt payments. Healthy companies often carry manageable levels of debt, where they have the cash flow to service their obligations even during challenging periods. Companies that are over-leveraged, on the other hand, can spiral into crisis if just one thing goes wrong. After analyzing profitability and debt, Dorsey turns to valuation ratios. Understanding a company's value relative to its price is one of the most crucial skills an investor can develop. Dorsey explains that one of the most common valuation measures is the price-to-earnings, P/E ratio. But he cautions that the P/E ratio should never be viewed in isolation. A low P doesn't always mean a stock is cheap, and a high P it doesn't always mean a stock is expensive. The key is to compare the P/E ratio to the company's growth prospects, its competitive position, and its historical norms. Another useful metric is the price-to-book (PB) ratio, which compares the stock price to the company's assets. This is particularly helpful when evaluating financial firms like banks and insurance companies, where the book value of assets carries more weight. Dorsey also highlights free cash flow as one of the most telling indicators of a company's financial health. Unlike accounting profits, free cash flow shows how much actual cash the company generates after covering its capital expenditures. It is the money that can be used to pay dividends, buy back shares, or reinvest in the business. A company that consistently produces free cash flow is often in a strong financial position. It signals operational efficiency and financial flexibility. But here's where Dorsey's advice becomes especially valuable. He teaches that context is everything. Numbers must be read in relation to the company's industry, its competitive environment, and its long-term trends. A good profit margin in the technology sector may not be acceptable in consumer goods. Debt levels that are reasonable for a utility company might be dangerous for a small retailer. You must always compare companies to their peers to get a realistic picture. Dorsey also warns against being seduced by one impressive number. A single ratio or a single quarter's performance can mislead you. Smart investors look for consistent patterns across multiple financial reports, and they study the story the numbers are telling over time. He emphasizes that understanding what to focus on is just as important as learning how to calculate ratios. Many investors get lost in financial complexity, but Dorsey encourages us to focus on the essentials. Are revenues growing sustainably? Are profit margins stable or improving? Is the company managing debt responsibly? Is it generating healthy, free cash flow? Are its valuation ratios reasonable compared to its growth prospects? By asking these questions consistently, you develop the ability to separate great companies from risky ones. Dorsey's approach is not about finding perfect companies. Those are rare. It's about finding solid businesses at good prices that can grow and endure. When you learn to analyze financial statements with this mindset, you reduce the chances of making costly mistakes and increase your ability to spot true opportunities. This section of the book arms investors with practical tools, not complex formulas, but clear guidelines for reading between the lines and seeing what the numbers are really telling you. As we continue, Dorsey will apply these lessons to specific industries. Each sector has its unique risks, growth drivers, and competitive landscapes. Understanding these differences is critical if you want to analyze companies in a meaningful way. Let's move forward. Chapters 14 to 26, Sector-by-Sector Investment Insights. Understanding the rules of each industry. In the world of investing, not all companies play by the same rules. Each sector has its unique characteristics, its own patterns, risks, and profit drivers. Pat Dorsey stresses that successful investors must tailor their analysis to each industry. What signals quality in one sector might signal danger in another. This section of the book walks us through key industries, helping us sharpen our lens when evaluating companies in different sectors. Let's begin with the consumer goods industry. Companies in this space, like Procter & Gamble or Coca-Cola, often benefit from brand strength and customer loyalty. Pat Dorsey explains that consumer goods companies typically grow steadily rather than explosively. Investors should look for strong brands, wide distribution networks, and the ability to pass rising costs onto consumers without losing market share. Pricing power is key, but beware of fads, products that seem hot today but quickly fade. Smart investors differentiate between durable brands that people will buy for decades and short-lived trends that quickly disappear. Next, the healthcare sector. This is an industry driven by life-saving products, but it's also heavily influenced by regulation, patents, and scientific breakthroughs. For pharmaceutical and biotech companies, patents create temporary moats that expire. Investors must look carefully at a company's product pipeline. Are there promising new drugs in development to replace those losing patent protection? In healthcare, it's not enough to see strong current profits. You must assess whether those profits can continue as competition generic drugs, and regulatory hurdles evolve. The next sector is financial services. Banks, insurance companies, and asset managers operate under their own unique financial structures. When analyzing financial firms, Dorsey highlights that return on equity, ROE, and consistent earnings matter more than growth rates. Look for banks with sound lending practices, conservative debt levels, and a proven ability to manage risk. For insurers, the strength of the underwriting process is critical. Companies that consistently price risk correctly tend to outperform. Watch out for financial firms that chase high-risk strategies. They can unravel quickly in turbulent markets. The technology sector. This is one of the fastest-moving industries, but it's also among the most challenging to evaluate. Products become obsolete quickly, and today's leader can become tomorrow's failure. In tech, a strong moat often comes from network effects, high switching costs, or intellectual property. Dorsey warns that investors should be especially cautious of hype in this sector. Strong revenue growth can look impressive, but without durable competitive advantages, it may not last. Focus on whether customers are locked in and whether the company has built platforms that are hard to replace. The telecommunications industry. These companies typically face heavy regulation and significant infrastructure costs. Moats can exist through government licenses, scale advantages, and customer contracts. But Dorsey reminds us that telecom companies often carry large amounts of debt, and they can be vulnerable to price wars. Look for stable cash flows and disciplined capital investment strategies. Moving into utilities, Dorsey highlights that these companies are often protected by local monopolies and regulatory structures. They tend to have predictable revenues and offer steady dividends. But growth is usually limited and heavy debt is common. Investors in utilities should focus on regulatory relationships and whether the company has a history of responsible financial management. The energy sector, covering oil, gas, and alternative energy, operates under commodity pricing. Dorsey emphasizes that energy companies often have little control over the prices they can charge. The key here is to look for companies with low-cost production advantages and proven reserves. Energy is cyclical, so investors should be prepared for volatility. Balance sheets, cash flow stability, and production efficiency are crucial factors. In the industrial goods sector, Dorsey points out that scale and efficiency can create advantages. Look for companies with strong distribution networks, repeat customers, and cost structures that allow them to weather downturns. However, cyclicality is a major consideration here. Profits tend to rise and fall with the broader economy. Smart investors look for businesses that maintain profitability even during economic slowdowns. When it comes to media, the landscape is rapidly changing. Traditional media companies, like newspapers and cable networks, are losing ground to digital platforms. In this space, moats often come from exclusive content, customer subscriptions, or dominant digital platforms. Be cautious of companies overly dependent on advertising revenue alone. Shifting consumer behaviors can quickly erode profits. In the retail sector, cost advantages, brand strength, and customer experience matter most. Brick-and-mortar retailers must battle online giants, while e-commerce players must scale efficiently. Retail is fiercely competitive, and margins are thin. Look for companies with strong supply chain management and loyal customer bases. For real estate investment trusts, REITs, understanding the quality of assets and lease structures is essential. Dorsey emphasizes that location is everything. REITs with properties in high-demand areas tend to outperform. Balance sheets matter, especially in periods of rising interest rates, which can increase debt servicing costs. Investors should also watch occupancy rates and rental income stability. In transportation, whether it's airlines, shipping, or railroads, scale and cost management are crucial. Railroads often have the strongest moats due to limited competition and high barriers to entry. Airlines, on the other hand, are notorious for weak pricing power and high fixed costs. Investors must be cautious and focus on efficiency and disciplined growth strategies. Dorsey concludes this sector-by-sector guide by reminding us that each industry has its own rules, risks, and financial markers to watch. A successful investor adapts their analysis based on the sector, understanding that no single approach fits all companies. What works in utilities won't work in tech. What's acceptable debt in telecom could be dangerous in retail. The key is to develop industry-specific lenses. When you know how to evaluate a company within its sector, you gain a significant edge. You can more accurately assess which companies have true staying power and which are riding temporary waves. This knowledge arms you to make smarter, more informed decisions, not based on hype, but grounded in the realities of each industry. In the final part of the book, Dorsey will summarize the 5 rules and reinforce the importance of discipline, patience, and process. Let's move forward. Final summary and closing insights, the 5 rules that build wealth. As we approach the conclusion of this remarkable guide, Pat Dorsey draws our attention back to the core of successful investing. Through every chapter, every analysis, and every example, his message has remained focused and consistent. There are no shortcuts. There are no magical formulas. There are only disciplined steps applied consistently over time. Dorsey's 5 rules form a complete framework, a timeless roadmap for anyone who wishes to grow wealth steadily in the stock market. Let's revisit these 5 essential rules, not as isolated steps, but as interconnected principles that reinforce each other. Rule 1. Do your homework. The journey always begins with research, not casual reading, not surface-level impressions, but deep, thoughtful study of the company's fundamentals. Dorsey insists that you must understand what the company does, how it makes money, who its competitors are, and what risks it faces. Lazy investing is dangerous investing. When you thoroughly research a company, you build the foundation for sound decisions. You're no longer swayed by headlines or market hype because you know what you own. Rule 2. Find economic moats. The best companies have durable competitive advantages that protect them from rivals. Whether it's brand strength, cost advantages, network effects, or high switching costs, a moat keeps profits safe. Without a moat, even a well-run company can be quickly overtaken by competitors. Dorsey shows us that great investors look beyond the surface to find businesses that are difficult to dislodge. Rule 3. Have a margin of safety. No matter how great a company is, the price you pay matters. A margin of safety means buying a stock when it's undervalued, when the market's price is meaningfully lower than the company's intrinsic worth. This margin protects you from unforeseen problems, market downturns, or mistakes in your analysis. It's a cushion that allows room for error. Rule 4. Hold for the long haul. Building wealth in the stock market requires patience. Compounding works wonders over time, but it needs years, not weeks. When you find great companies at good prices, holding them through market cycles allows your investments to grow. Jumping in and out of stocks often destroys wealth. Staying invested in strong businesses, even when the market is temporarily fearful, is one of the most powerful strategies you can follow. Rule 5. Know when to sell. Patience doesn't mean blind loyalty. Dorsey teaches us to regularly check whether the company's moat remains intact, whether management is still focused, and whether the stock's valuation is still reasonable. Sell when your investment thesis is broken. Sell when a company's fundamentals deteriorate, when its competitive edge disappears, or when the stock becomes dangerously overvalued. But never sell in a panic over temporary market noise. Throughout the book, Pat Dorsey gently reminds us that discipline is the ultimate key to successful stock investing. Most investors know what they should do, but few actually follow through. The emotional pull of the market, fear, greed, impatience, leads many to make decisions that sabotage their long-term success. Dorsey's framework is not complex. It doesn't rely on secret formulas or privileged information. What makes it powerful is its simplicity and its focus on timeless principles. But simple does not mean easy. It takes discipline to do your homework when it's tempting to follow the crowd. It takes discipline to wait patiently when others are chasing quick profits. It takes discipline to sell when the evidence says you should, even if the market disagrees. Pat Dorsey gives us more than a set of rules. He gives us clarity in a noisy world. He shows us how to focus on what truly matters: Real businesses with real advantages, bought at real value, and held with real patience. If you apply these 5 rules consistently, you will likely outperform most investors. Not because you found a magical edge, but because you've embraced discipline in a market where many fail to. In closing, remember this. The stock market will always test you. It will tempt you to react emotionally, to chase trends, to abandon your process. But when you stick to these 5 rules, you're giving yourself the best chance to build lasting wealth. The power is not in predicting the future. The power is in following a proven process, day after day, with calm, patience, and confidence. Thank you for listening to this audiobook summary of the 5 rules for successful stock investing by Pat Dorsey. If you found this audiobook valuable, make sure to subscribe to this channel for more deep, high-quality summaries of the most impactful wealth-building books. Share this with someone who is serious about mastering the art of smart investing. And remember, this content is for educational purposes only. Always do your own research or consult a qualified financial advisor before making investment decisions. Stay disciplined, stay patient, and stay invested in your learning.